everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are going to take a little bit of a left turn here. We've been talking about the Fed. We've been talking about what's been going on with the dollar. We've been talking about other central banks. We've been talking about China. There's one topic that we haven't really touched very much on Macro Money, but for episodic conversations, and that is, of course, the Russia-Ukraine war. And we haven't touched it because it doesn't lend itself easily, when we talk about geopolitics, to macroeconomic analysis. But when these things intersect, they cannot be ignored, and we do need to pay attention. And we actually have an important consideration here emerging over the next week or so that could be a major market mover and a major source of impetus for all of the other things that we're talking about. The Fed, inflation, interest rates. And so what we're going to do here is we're going to ask ourselves if Russia is going to blow up the export deal that it has with Ukraine on moving foodstuffs, in particular grains, out of Ukrainian ports, even as the fighting continues. A deal that comes up for renewal next week on May the 18th. So let's dig in here and let's have a look at what the moving parts are and what this is and what's going on. Let's do some stage setting and then see whether Russia is likely to renew or not renew, and what that would mean for markets. So we begin with a kind of timeline here, taken from the purview of wheat futures. Wheat is, of course, a market in which Russia is the largest exporter, and Ukraine is a top 5 exporter. So needless to say, the war here is a major risk for wheat shipments. And of course, wheat is an absolutely essential staple crop for food in much of the world. And of course, I'm thinking in particular about China. I'm thinking about the Middle East here, which import humongous volumes of wheat. So here's a timeline here. Notice that we begin with a radically sharp spike in wheat prices as the war initially gets underway, for all of the reasons that we've just discussed. That's this right here. So Russia invades Ukraine, wheat prices spike. They then come down and begin to sort of idle because, of course, inventories remain. This is a disruption that is something that doesn't bite immediately. It's a fear, but it's not an imminent fear where if shipments stop right now, people start to starve right now. Silos contain wheat. There is a bit of a lag here. And just as we get this, you get the UN and Turkey start to talk about how they can carve out some kind of a deal to get shipments of wheat out of Ukrainian ports. And at the same time, to get them out of Russia, which at this point is in the midst of getting hit with sanctions. Some of those first steps in implementing this deal. It's not really a deal yet, but Russia starts to take some constructive steps here. They start to change the way that they block shipping into Ukrainian ports with their navy to allow safer passage for merchant vessels. So you see that as you get some spiking around here, you begin to have what is speculation about a larger deal and then a protracted decline. The deal is confirmed here. This is late July here, where you get the Black Sea Grain Initiative, or BSGI, actually signed. It gets re-upped for 120 days here in November, and most recently gets re-upped for 60 days in March. Those 60 days expire next week, as I say, May the 18th. So clearly, the price of wheat has been doing nothing but falling for much of the war, which seems counterintuitive. But nevertheless, here we are, supplies are getting out. Now, of course, Ukrainian production capacity remains substantially hampered, not only because they're in the midst of a war, but also because Russia keeps bombing it. And probably will continue to. Nevertheless, here we are with a much more significant amount of exports coming out of Ukraine than would be were this deal not in place. But because their output is significantly hampered as relative to what would be the pre-war average, we still have to ask, how is it that we're getting this protracted decline? Well, one argument would be to look at what is the global trade story and say, well, global trade overall is declining. The price of commodities in general has been hampered because what we have is a Fed-led rate hike cycle that is increasing the cost of doing business around the global financial markets. It is slowing global activity in general. As you start to see rates go up, you have a broad-based topping and deceleration in global trade volumes writ large. Demand is weaker. So maybe this is what's going on. You just have a situation in wheat and in some of these other commodities that is exactly a part of this global story. You have this global initiative in place to get stuff out of the Black Sea area. This is a demand story. It's a compelling argument. And there's certainly some element of the story that this speaks to. In fact, you can see it here in sharp relief. So there's that global trade turnover in the dark blue. That's that same line here, which you can see tops and starts to go lower as Fed rates go up. And you can see in the red is wheat. That's the ZW future. And in the orange is the Bloomberg Commodity Index. That's a catch-all for global commodities prices. It's available as a future. It's available as an ETF. And, of course, it's available as an index standalone, but a broad-based kind of measure of commodity prices. And, indeed, you can see that with the turn in global trade turnover, you have a turn in commodity prices in general, and also a turn in wheat in tandem. So surely this is at least some of the story. Doesn't feel like it's all of the story, though. And indeed, we can see here that while the overall commodity index is at latest reading down 19.6% year on year. And this is a daily chart. So these numbers are as of today. So as of today, the commodity price index is down 19.6% from a year ago. And you can see that these year on year percent change numbers have been getting increasingly more negative since the beginning of the year here, and really were already trending lower and becoming smaller and smaller and smaller in their gains from the beginning of last year as the war got underway. Now compare how that overall commodities index down 19.6% year over year, compares with the three top exports out of Russia: wheat, natural gas, or petroleum gas, either way, and crude oil. Wheat is down 50% year on year. Oil is down almost 24% year on year. Nat gas is down 76.6% year on year. This cannot be just about global tightening. It cannot be just about what's going on in the overall commodities complex, because clearly these things are down much more than the benchmark. Crude oil is kind of close. But wheat and natural gas are down twice more and 3 times more than is the benchmark. When really what we should be seeing is these commodities be down less, one would think, because they are the most hampered by sanctions and a war. So what gives here? Well, clearly there's something else. This is not all of it. Something else seems to be going on. Here, hat tipped to the Observatory of Economic Complexity. I didn't even try to make my version of these excellent charts that they have. The OEC clearly is doing an incredible job here, visualizing all of this. And so we'll just go with their charts. This is Russian exports since 2019. The thing to notice here is the ramp up that you see as the war gets going. Here is the beginning of 2022. The war gets started right around here. Notice what's going on. There is a pointed ramp up in export volumes. Now, of course, we can look here and see that the ramp up is beginning to tilt more and more toward countries that are not participating in the sanctions or halfway participating in the sanctions. So you can see China is taking an increasingly bigger slice. India is taking a bigger slice. So there's clearly some reshuffling. But the overall direction here, especially in the early stages of last year, going into the middle and toward the beginning of this year, pointed very much to the upside. And so it would appear that what's going on is that for those commodities that Russia excels in, it is actually ramping up shipments. And if we look at the latest commentary out of the WASDE report, which is from the USDA, the U.S. Department of Agriculture, that tracks all of these things, that's a weekly report. We'll get the latest one tomorrow. We get reports of the cheapest pricing coming out of the Black Sea region. And there being a tremendously potent effort to undercut global prices with this output. That essentially what Russia is trying to do here is drive prices for its own exports lower. Now, one could make the argument that, of course, Russia needs to fund a war. And so it might have been motivated to weaponize its exports and try to drive prices higher. First of all, to put some pressure on Western markets that rely for these exports. Obviously, there was much made of Russia weaponizing natural gas ahead of the European winter, which ultimately didn't really take place at the scale that people were worried about, not the least of which because the Western Europeans built up giant stocks of natural gas, and because the winter ended up being warmer, and because natural gas is really only used for heating and not for industry, and you can also use electricity for that. So there's a clear substitution mechanism. But nevertheless, Russia didn't really try in earnest. It might have. It might have done so with wheat. Certainly no easy substitution like there is for natural gas as a heating source in Europe there, when you talk about dependencies around the world, be it the Middle East, be it China. So it might have weaponized these exports, but it's not doing that. Why? Why is it that Russia, at a time when it needs to raise money to fund a war and is hampered on global markets and has this trickle through the sanctions for energy and grains, why is it trying to undercut the price? Well, now obviously I don't have a direct line to the Kremlin to know for certain, but there does seem to be a strategy that seems to suggest itself here in my positing of what could be going on. Well, consider this. What we see here on the screen is the makeup of the wheat market, and all praises here once again to the OEC, the Observatory of Economic Complexity, for an excellent chart, which I will happily reuse. Hat tip. We can see here that if Russia were to try to gouge markets and create an opportunity for competitors to take up market share, those competitors would be largely on the other side of their current conflict. France, US, Canada, Australia. So perhaps if Russia were considering a short war that it thought it could deliver on quickly, where there wouldn't be time to substitute to these other producers, well, then maybe that kind of action would make sense. But losing market share, if you are in for a protracted war, that's bad policy, it would seem, because you do have to fund that protracted war somehow. You're under sanctions. It's difficult to sell anything at all. You have this outlet for grains and for energy. You're going to try to make as much of it as you can, I would think. And so you want that income continuing to flow through. And in so much as it is already difficult to do business with Russia because of all of these sanctions, perhaps you undercut on the price that you charge to make sure that you don't lose this market share to what is, in the current situation at least, ostensibly the enemy. You see something very similar in these other top commodities that we've been looking at. Here's crude oil. Who would Russia be giving up market share to here if it were not undercutting and trying to retain it? Canada, the US, Norway, US allies like Saudi Arabia, the UAE, Kuwait. So what you're looking at, again, is a situation where if Russia wants to maintain a flow of money from these exports over a prolonged period of time, battling for market share, retaining market share in adverse circumstances becomes an important sort of priority. Same thing for natural gas. In the OEC parlance here, petroleum gas. Who is the competition there? The U.S., Australia, Qatar, which is an ally, Norway. So again, same consideration. And so the question then becomes, well, why is Russia angling for a protracted war? If this is in fact what the logic at the Kremlin looks like, why are they angling for a long conflict? Well, consider this. And these are not done to scale. So if you see, for example, that the blue parts and the red parts don't really seem to be correctly sized given their number values, that's because I shrank this image to fit on this slide. So hat tip to the global firepower index, which is where this data comes from. You can get the properly scaled images directly there. But the message is nevertheless the same. Consider how much of a manpower advantage Russia has in terms of available manpower, in terms of fit for service numbers, in terms of the numbers of new recruits reaching military eligibility age, in terms of active personnel deployed. And consider that every major war that Russia has won, it has done so by throwing bodies at the conflict. In an attrition sort of war, Russia has more people, and it can last longer, all else being equal. So after the initial blitz to Kiev didn't really seem to get off the ground at the beginning of the war, perhaps what we're looking at is Russia saying, well, the way we win this is with bodies. And if we're going to dig in here and be in a war for a long period of time and sustain heavy casualties, but ultimately outlast the other side, much as Russia has done when it's won other major conflicts, certainly the relatively short burst in Georgia in 2008 and the issue in 2014 in where Crimea was taken largely without firing a shot, notwithstanding. Those are not a part of the sort of dynamic that we're talking about here, but large wars, major wars that Russia has won, it's tended to win them with overwhelming numbers of people and just being able to outlast the other side by sustaining heavier casualties, but ultimately prevailing in an attrition strategy. If this is where Russia is going, it needs to be able to sit for a long period of time to execute. And to do that would allow enough time for buyers of Russian exports to build other markets, to find other supplies, and ostensibly to cut off the flow of money to Russia that is there, all the things hampering those flows notwithstanding, and also to hand its market share to the other side of the current conflict, which is obviously not to Russia's advantage, I would think. Which then, of course, raises the question of the grain deal renewal and what's going to happen next week. Will Russia walk away from the deal? Well, if this is the dynamic at work, one would think probably not. One would think Russia would not want to abort the grain deal, would not want to stop shipments, would want to continue to flood the market with cheap wheat and oil and natural gas to maintain market share to execute on this strategy. And so while there may be some back and forth around this, and we might certainly be concerned that perhaps if Russia were to make this move to abandon the deal and commodity prices were to surge, that this would boost inflation, even as it hurt growth, and put central banks into a real tough stagflation kind of environment. But that's probably not on the menu. And those fears, even if they were to emerge between now and then, probably don't have follow-through in markets. For instance, if there were a spike in wheat prices between now and May 18th around speculation that Russia would abandon this deal, it seems likely that such moves are unlikely to have follow-through, unlikely to have legs, unlikely to change the underlying trend. And so disinflation globally probably continues. And central banks probably stay on course. Because from Russia's perspective, keeping supplies ample and its exports cheap seems to make sense when everything is considered. And that is Macro Money for today. It's the last show for us of this week. We're here Monday through Thursday, just after overtime, where Chris Vecchio, head of Futures and Forex, and I look at the preceding day's events and try to contextualize them within markets and tactical strategy. I'm also on with Chris for Futures Power Hour on Fridays, and then on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm opining on Twitter at Ilya Spivak. Thank you very much for joining me. Good luck trading out there. See you next week.